In 2020, two things happened that could fundamentally change the world economy for years to come. These were 1. The global pandemic, and 2. Government responses to it. But economically, I have a feeling that number 2 is going to be that much more pervasive. This is because it's helped to spawn the rise of hundreds, nay thousands of zombie companies. Companies that feed off cheap dollar debt as they rob the country of its productiveness. What's really scary is that these living dead corporations are going to stick around long after we go back to our normal lives. And they are going to decimate stock portfolios. Gloomy, right? Well, in this video, I'm going to give you exactly what you need to know about these zombie companies. I'll take you through some of the basics of zombie companies and how they could threaten the economy. Finally, I'll be giving you some tips about how to protect your wealth from this zombie scourge. Before we take a walk through the land of the living dead, we have to lay out some ground rules. Don't let this epic swag fool you. I am not a financial advisor. That means that you won't be getting any financial advice from me. It's merely an educational video to help complement your own research. With that out of the way, I would like to welcome all the new viewers that we have today. My name is Guy, and this is the Coin Bureau. Over here, I cover everything from project reviews to market analysis and deep dive investigations. If that tickles your fancy, then tick that subscribe button. Don't forget to turn on all those notifications too to make sure you don't miss another video. And finally, I want to draw your attention to these timestamps right over here. They are there for your convenience, so feel free to skip around if you're pressed for time. I promise I won't be offended. Alrighty, let's get going with the dawn of the dead. So, what the hell is a zombie company anyway? Well, quite simply, it's a company that earns just enough operating income in order to service its debt. Given that these companies are just scraping by and meeting their operating and debt expenses, they have no money left over in order to fund further growth. This means that the company does not really have any chance of paying off the outstanding debt, let alone increasing value for its owners. The term has been around for some time and was originally popularized in Japan's lost decade of economic growth in the 1990s. It was in this period that these large Japanese companies were dependent on bank backing to remain in operation, even though they were bloated, inefficient, or failing. Zombie companies generally tend to occur in those industries that have had major disruptions in their earning power. This means that in order to continue meeting expenses, the companies resort to borrowing. Since 2008, there were a number of zombie companies that cropped up in the West. Here you can see the growth of listed zombie companies in data from The Economist. In 2018, a full 15% of all listed firms were in a zombie category. Some of these companies may have taken on debt, and others may have been helped by the government. The latter were considered, quote, too big to fail, and were hence propped up with favourable government loans and creditor treatment. In many cases, they're also given taxpayer-funded bailouts that only prolong their inevitable failure. These taxpayer-funded zombie companies are even worse than your typical debt-laden firm. That's because, given their favourable treatment, a moral hazard has been created and they're not incentivized to diversify their earning potential. Whereas other zombie companies don't have the means to source new revenue streams. Too big to fail firms don't have the incentive to. So, you may of course be wondering, what's the big deal with zombie companies anyway? Well, they lower average productivity. Many economists argue that these zombie companies are detrimental to society as they lock up market share and talent that could be better deployed to more successful, nimble, and dynamic companies. Moreover, given that they have no excess cash to invest, they're not investing in increasing general economic productivity. Indeed, capitalism is all about creative destruction, an economic notion which says that companies which are uncompetitive must make way for those that are. However, this is all assuming that the company has progressed to that living dead status gradually and over a number of years. An outcome that has occurred due to these shifting trends I mentioned. Trends that many people can see and predict. However, zombie companies can also be the result if there is a sudden and severe shock to earnings, an unexpected event that no one could really plan for. Something like, say, a global pandemic. COVID has no doubt changed the world as we know it. I personally want a refund on 2020. However, the impacts of the virus have been that much more acute for those industries and companies that have had their earnings decimated by it. This is particularly so for those companies that operate in sectors like retail, hospitality, travel, tourism, etc. For some of these companies, revenue fell by more than 90%. From airlines to hotels and restaurant groups. The second quarter was no doubt a dark time for many of these companies. In order to survive that period, many of them took on debt. Some companies were lucky enough to have gotten government-funded low-interest loans and other forms of support. However, these were still loans, and eventually debt will have to be paid back. We now also have a situation where the second COVID wave is raging in numerous countries. This is coming at a time when these companies are trying to make up for the lost revenues that they suffered in Q1 and Q2. This perhaps means more debt to last them through till next year. The actions by the Fed have also made it quite easy for these companies to continue the borrowing. Given that interest rates are near record low levels, companies are perversely incentivized to pile on this debt. They may as well if it means paying the bills. And for some of those firms that are considered too big to fail, the government is likely to open up its coffers once more. Airlines, hotels, cruise companies, and other large and supposedly vital companies are kept on life support until the COVID storm passes. Now, of course, it seems as if the storm is indeed likely to pass. We've recently got the news out of Moderna that their vaccine candidate has proven to be 95% effective in early trials. Similarly, Pfizer is claiming their vaccine candidate is 90% effective. Moreover, there are hopes that these firms can scale the production and eventually start shipping the initial doses before the end of the year. In the best case scenario, life could be somewhat back to normal for us by the summer of next year. However, things are not likely to go back to normal for these unfortunate zombie firms. Allow me to explain. Firstly, let's consider that vaccine. It's not as if we can turn on a switch where entire countries can immediately be immunized against the virus from day one. Scaling and distributing this vaccine will be a mammoth task. Even if most developed nations in the world can start the vaccination drive early next year, it will only be a full year before travel will be eased and all restrictions raised. Moreover, there's also no certainty around how long the immunity of this vaccine will last. This means that people may have to get regular shots on a seasonal basis, similar to the way flu vaccines work, for example. This will mean that travel will still face challenges until we have people getting the shots in the regularity and scale required to be safe about it. So, for many of these zombie companies, it could be quite a while until they're earning anything close to pre-pandemic revenues. Therefore, these companies are likely to have to continue borrowing in order to keep afloat. Indeed, this should not be too expensive initially, as interest rates are likely to be quite depressed for some time. The low rates create a perverse incentive for these companies to continue borrowing. I'm also of the view that many governments will continue to support some of these companies. For example, it's likely that the US will pass a second stimulus bill, which will see additional supports for some of the vulnerable industries. Now, while this will help hold over some companies, it leaves them heavily indebted. When things do get back to normal in the country, these companies will have less earnings after interest to adapt their business models. Most of their operating income will go to servicing that debt. This means less retained earnings to spend on research and development, for example. Less retained earnings to be distributed to shareholders. And generally less innovation in the sectors that need it most in a post-pandemic world. This is, of course, less than optimal for the broader economy as a whole and leads to the misallocation of capital to unproductive means. It means that employees that could be working in a more dynamic and trailblazing startup are stuck in a zombie company just plodding along. However, a misallocation of capital is the least of our concerns from these zombie companies. Eventually, there will come a time when that government support will stop coming. when easy credit and loan guarantees start to dry up. This is a world in which those zombie companies tend to eventually die. So, let's take a look into it. It's not only the companies that have been borrowing to the hilt in the pandemic. It has also been the governments. And most countries are eager to wind that back, lest they land up in a post-COVID basket case. As the governments do this, they will stop supporting some of these zombie companies. That means that low interest, government-backed loans and other guarantees may not get renewed. Those companies that were solely reliant on these guarantees to make it through are likely to face mounting losses. This means that for any of those companies that have private sector debt, their credit rating is likely to fall and their interest rates are likely to spike. Higher interest rates on their debt will further eat into their earnings and further drive up their losses. Eventually, the cost of servicing the debt becomes so large that these companies cannot conceivably operate as a going concern. They'll have to enter some form of bankruptcy in order to protect themselves from their creditors. In the United States, this is called Chapter 11 bankruptcy. Indeed, there were a number of companies that did this already in the pandemic as the eventual feasibility of their business models were questioned. I covered these in my video on shitty stocks, which you can watch right over here. So, the question has to be asked about how many of these companies are likely to enter bankruptcy in order to grant them a reprieve from their creditors. According to research from Deutsche Bank, the pandemic has left a situation where at least 1 in 5 publicly traded US companies are zombies. This is a full 10% more than the figure pre-pandemic that I mentioned earlier. And when a company enters bankruptcy, this means that it has to restructure some of its operations. This inevitably means that it'll have to sell off some assets and decrease business lines. This could also have a human cost component, as the company may have to downsize. Now, of course, we've just been talking about the companies themselves. There are a number of macroeconomic impacts on these highly indebted companies too. Firstly, it's well known that some of these zombie companies can have a negative impact on economic growth. For example, thanks to Japan's experience in the 1990s, we have an interesting case study. For those that don't know, the 1990s was seen as Japan's lost decade of economic growth. It was a decade where Japan lagged considerably behind all other industrialized nations in economic growth. A number of factors could have contributed to this, but one of the most well-known was the prevalence of those zombies. Instead of writing off these loans on their balance sheets, Japanese banks kept on lending to these firms. This kept them in a perpetual state of just surviving. When we enter a post-pandemic world, the entire world is likely to face a much bigger horde of these zombie companies than Japan ever had to deal with. This is a major concern that's been raised by numerous people over the past few months. So it's quite clear that countries will want to avoid this outcome. No one wants to live through a period of stagnation, especially after the economic shock that COVID has wrought. Of course, letting all these companies fail the moment we come out of this pandemic is not a great outcome either. While it could be better for the longer term, it could really hit the post-pandemic recovery hard. If these companies fail, then there's likely to be a slew of job losses. Job losses mean lower incomes to spend and hence less economic growth. So, what you're in is a situation of damned if you do, damned if you don't. It's a tricky one that's hard to navigate, and there are no silver bullets here. Now, I know what you're thinking. Guy, what does this have to do with me? Well, actually quite a bit. Firstly, if you're the kind of person that holds any stocks, these zombie companies could be a threat to your portfolio. This is especially true if you hold a broad stock index in your 401k or equivalent. This is because these zombies make up a fair proportion of most stock indexes out there, currently about 25% of listed firms. These are indexes like the S&P 500, Russell 2000, FTSE 100, etc. If they continue to underperform, then their earnings will falter and it will impact on the returns in the index itself. Moreover, if these firms are kept alive by governments and easy debt, then they will further lead to inefficiencies in the economy and a misallocation of both capital and labour. Anemic growth and lack of innovation are not good for anybody in the country. Of course, the alternative situation of letting them go under or enter bankruptcy is also suboptimal for anyone who has them in their portfolio. Bankruptcies don't do too well for the price of a company's stock. Don't tell the Robinhood traders that. And so far, I've only been talking about those large listed zombie companies. There are hundreds of thousands of smaller companies and businesses that may also fall into this category. These may be smaller public companies, private companies, and other SMEs. Now, although these companies may not form a part of your personal stock portfolio, they are important components of the broader economy. If you have thousands of these smaller businesses closing up shop, the multiplier effect on demand in the economy is likely to be substantial. You have fewer companies buying goods and services, and fewer people employed by said companies. People who would have helped to contribute to consumer spending, which of course further adds to economic growth. So, these zombie companies are a serious threat to your stock portfolio, either directly through their underperformance or indirectly through their impact on the broader economy. Now, I'm not all about doom and gloom. There are ways to secure your investments and hedge against the risk from these ghouls that dot the economy. And I bet you folks have an idea of what I'm going to say. There is a reason that I hold the majority of my wealth in cryptocurrencies like Bitcoin and Ethereum. They have defined and unique characteristics that other asset classes just don't match up to. For example, one of the main reasons that I hold Bitcoin is because it's a scarce asset. There are only ever going to be 21 million Bitcoin mined. By owning one Bitcoin, you are already part of a very small and exclusive club. Fun fact, the total number of dollar millionaires in the world right now is about 51 million people. That means that there is not enough Bitcoin to go round for each of them to even own half of one. In fact, the number is likely to be even lower than that, given that there is a lot of Bitcoin that's been lost. Owning an asset limited in supply is also advantageous from an inflation hedge perspective. If you watch my video on post-lockdown inflation, you'll know why I'm so worried about it. If you haven't seen it already, then you can watch that bad boy right here. Its scarcity is not the only reason why I hold Bitcoin. It's easy to store, transfer, and control. It's basically a personal Swiss bank account that could one day hold millions of untapped wealth. When it comes to Ethereum, my investment is based on the immense value of the underlying network. It's the protocol layer for the decentralized finance revolution. In fact, over 90% of the most popular dApps have been built on Ethereum. You can think of it as akin to owning a piece of the TCP/IP protocol. However, you own a piece of this network in the early 1990s, when the internet revolution is just taking off and thousands of websites are being built on top of it. In fact, this network valuation method has a name, and it's called the FAT protocol theory. If you want a more in-depth overview of how this valuation methodology works, then be sure to watch my vid right over here. Of course, these were just some of the longer-term fundamental reasons that I hold these assets. There are also a lot of things to look forward to in the coming year. On the Bitcoin side, you have a flood of institutional and corporate adoption that is FOMOing into the market like never before. This has driven Bitcoin to prices that have not been seen since the great 2017 bull market. And there are many analysts who think that we could soon be breaching those previous all-time highs. Over on the Ethereum side, you have the upcoming launch of ETH 2.0. This is the much-needed network upgrade that could finally make Ethereum more scalable. This means more utility and hence more demand according to that FAT protocol theory. No doubt, also a reason for that recent rally in the price of ETH. And of course, neither asset is that badly impacted by the presence of these zombie companies. They are governed by code and run by a decentralized network of nodes. As the zombies start dying off, they keep ticking on, block by block. This video is getting long, and I think I've made my case. I want to leave you folks with a few final thoughts though. If there's one thing that's certain, it's that the pandemic will have a lasting impact on the global economy. Even if we're able to return to some sort of normality post-vaccine, it will be a different normal. A world in which we've highly indebted companies that struggle to generate enough earnings to get out of debt holes. These zombie companies are likely to be a massive drag on the economies of most of the industrialized world. Of course, how the zombies impact on the economy will be dependent on how governments deal with them. Do they prolong their demise with additional debt and support? Or do they let corporate natural selection run its course? Both are not really desirable outcomes, and I'm glad that I don't have to make the choice. Either way, a V-shaped recovery seems less likely in the face of these living dead corporates. And if you hold stocks, it means that you either have direct or indirect exposure to them. The only place that I found refuge from the vagaries that can be wrought by zombie firms is in the crypto markets. Now, admittedly, I am a crypto guy, and I've been investing in these assets long before we had a global pandemic. However, it has further reinforced my view about cryptocurrency's value proposition. And given how the markets have been performing lately, it seems as though many other people have come to a similar conclusion. Now, that was an interesting video to make, but that's just me. I need to hear from you fine people. Are you worried about the zombie apocalypse? Anyone disagree with my analysis? I'd love to hear from you in the comments. Oh yes, and in case you folks are dying to get your hands on this lit crypto merch, now's your chance. I am selling these t-shirts in my own personal merch store. All sales help support the channel and keep this top-notch content gushing forth. You can find a link to the store in the description below. Finally, folks, thank you so much for watching. If this crypto guy lived up to your expectations, then hammer that like button hard. Hit that subscribe as well if you want to be kept in the loop of the latest and greatest at the Coin Bureau. I'm so glad you made it to the end of that video. Now that you're here, I have something interesting to share. Have you heard of my weekly email? Basically, it's my personal take on the crypto markets. Everything from hot projects to hot coins. Unique insights on market movements as well as some news that may have dropped off your radar. That sound appealing? Well then, I'm inviting you to sign up. Head on over to the description right now. There is a link to my sign-up form. Then you pop in your email and hit submit. Then you'll just have to confirm your email and that's it. You are locked, loaded, and ready to go. You may just catch my next newsletter, which you definitely won't want to miss.